Good day, everyone. I'm Michael Chang, Chief Investment Officer Fixed Income at RHB Asset Management. Thank you once again for listening to this podcast. For the past months, we have seen rates rising, especially in the developed market (DM) spaces due to US taper concerns and the more encouraging US economic data being unveiled. US Consumer Price Index year-on-year has also been trending upwards, with the latest reading at plus 5.4%, slightly above expectations of plus 5.3%. The overall US yield surge trajectory has dampened emerging market (EM) local rates, albeit many in EMs, especially in ASEAN, when most of ASEAN are still rebuilding their economies gradually after a series of respective lockdowns. Stacking the returns of various asset classes, EM local currency debt markets seem to have underperformed across these asset classes. Year to date, as of 1st November, US equities did plus 22%, have led the outperformance of DM assets. Within EM, local currency debt was minus 7.2%, has underperformed hard currency debt of minus 1.46%, and EM equities of minus 2.05%. EM local currency debt has faced headwinds as DM rates volatility led to foreign selling pressure in high-yielding local currency debt, such as the South African rand, ZAR, and Indonesian rupiah towards end October. Drilling within EM further, we can see that majority of the year-to-date local currency total returns have barely been positive, except for China, Indonesia, and South Africa. The Thai baht underperformed most within ASEAN. In essence, most EM local currency debt markets face negative yield returns amid higher US Treasury yields and elevated US dollar volatility. EM foreign exchange performance has been mixed, with the export-driven Chinese yuan and Taiwan dollar outperforming the Korean won. Going forward, we may see the Indonesia local debt market weakening as unattractive bond valuations have weighed on investor positioning. Foreign investor positioning appears light, while local investors' positioning is neutral. Indonesia 10-year yield spread over 10-year US Treasury remains tight at 452 basis points versus 5-year average of 514 basis points. The 10-year real yield spread is also below the 3-year average. On the contrary, valuations in Malaysia in terms of 10-year Malaysian government securities is cheap. It's currently trading at a spread of 212 basis points compared to the Malaysia's 5-year average of approximately 161 basis points. Against 3-year average, Malaysia is 170 basis points, reiterating Malaysia's attractiveness. Cutting across EM further, Asia local currency debt does not seem so bad when compared to EMEA and LATAM. Therefore, the fundamentals of Asia still remain relevant and constructive to a global portfolio. We saw positive turning points in relation to the situation of COVID within Asia, and that should support Asia investments. On 3rd of November, BNM has kept the overnight policy rate unchanged at plus 1.75%, and as unanimously expected. The statement was fairly neutral compared to September, but BNM continued to signal downside risk to both global and domestic growth stemming from uncertainties pertaining to the virus, even though with Malaysia's high vaccination rate. On inflation, the central bank provided a slightly more detailed outlook. It expects inflation rate to remain moderate in 2022 and expects core inflation to edge upwards but remain benign even the continued spare capacity in the economy and slack in the labor market. Previously, the central bank expected core inflation to remain subdued. The fact that the central bank retains such cautious language on both growth and core inflation is a clear signal that it does not expect any change in the policy rate over the near term, which is sensible given that the recovery is in an extremely nascent phase. Nonetheless, the government expects Malaysia growth to reach plus 5.5% to 6.5% for 2022 on the back of stronger economic recovery in the next 6 months due to the nation's reopening and expect improvements in consumer spending to rebound sharply at the end of third quarter and also fourth quarter, coupled with a sharp bounce back in Malaysia's tech exports following a short-lived slump alongside supply chain disruptions this summer. Lastly, I would like to end this podcast with one image for us to mull on what you think global central banks would do in 2022, and this map basically encapsulates that. It is likely that central banks are going at different directions on interest rates as growth rates remain largely uneven around the world, especially for the two economic giants, the US and China. We hope this podcast has been useful to you and thank you for listening.